Now, great. So we have come to the last session of today, and as mentioned before by Professor Ciccarone, we are particularly happy of this panel, which is the policy panel, which is always part of the New Frontiers in Banking and Capital Markets conference. You have at the table with me Paolo Angelini, Deputy Governor of the Bank of Italy, Carlo Comporti, Commissioner of CONSOB, which is the Italian Companies and Exchange Commission. Giovanni Sabatini is going to join us shortly. He got caught up in the traffic, who is acting chairman of the Executive Committee of the European Banking Federation and ABI General Manager. And last, but of course not least, Anneli Tuominen, a European Central Bank representative on the Supervisory Board. As mentioned, the idea is to provide food for thought for young researchers on what are the topical issues which are concerning supervisory authorities or bank managers, as we will hear the point of view of ABI and indeed the European Federation of the Banking Association. And ideally, the question that I asked my illustrious and distinguished panelists to address is actually to do with the title of the conference. So what are the new frontiers in banking from the point of view of supervisors, and then what are the new frontiers regarding capital markets? And so first of all, we shall hear the point of view of Anneli Tuominen, as I said, European Central Bank representative on the Supervisory Board. Thank you all very much for being here. It's a pleasure and a privilege to be able to moderate you this afternoon. Thank you very much.
Per iniziare vorrei ringraziare la professoressa Marina Brogi per il gentile invito qui alla Sapienza, in questa famosa università. Per me è un onore essere qua. Ci aspettano tempi molto duri, tanta incertezza in economia e geopolitica. A voi studenti vorrei dire: approfittate dell'occasione. Questo periodo è una miniera d'oro in termini di opportunità di ricerca. Segnerà il nostro futuro e quello della ricerca.
Bravissima.
And now I'm going to talk to you a bit about our supervisory priorities, how we see the situation at this very moment, and where do we see risks looming. Well, on surface, the banking sector looks pretty stable, but is that the case? I can argue that there are no reasons for complacency, and I would like to elaborate why I think so. But if we look at the history, the aftermath of the great financial crisis, it really saw an overhaul of the regulatory and supervisory structure in the financial sector, and the SSM was also established, and consequently the resilience of the banking sector has improved with banks stronger both capital and liquidity buffers. And even throughout the pandemic, the banks proved resilient, exhibiting capital and liquidity buffers which remained broadly unchanged at comfortable levels. But there one can say that government and central bank relief measures really were a significant element in maintaining financial stability. When it comes to today's situation, I doubt that we see such relief measures. I doubt that we see any moratoria as we saw during the pandemic. With the moratoria, there's the problem that the banks do not have anymore the visibility when it comes to their borrowers' standing. The Russian very brutal aggression against Ukraine led to another uncertain macro-financial environment with deteriorating economic forecasts, higher inflation and the impact of our energy supply. So far, also this macroeconomic shock has not significantly impacted the banks, with on aggregate in the first half of 2022 an average common equity tier 1 ratio comfortably above the regulatory minimum requirements. And the profitability of the banks has continued to improve. And in terms of liquidity, banks have maintained strong position. Also, the NPLs have come down during the first half, and according to our preliminary figures, also during the third quarter. But even though the banks have proven resilient so far, they should be prepared for possible adverse scenarios under the current uncertain environment. For example, the banks might profit now from the higher interest rates. By the way, some banks do profit, some banks do not profit so much. But this could, at the same time, in combination with the inflation, also lead to defaults by borrowers. Now I think of households that are simultaneously hit by higher interest rates, by high energy prices, by high food prices. This entails a deterioration in their debt servicing capacity. And at the same time, there is downward pressure on house prices in many countries. I would therefore like to emphasize the significance of a proactive use of the available macroprudential toolkit. Of course, at this very moment, it's a bit too late, but this is really an advice for the future. Because in addition to the adequate macroprudential buffers, it's the borrower-based measures that are efficient in moderating the impact of such vulnerabilities in the housing sector as we are experiencing now. Unfortunately, the borrower-based measures, when you limit the capacity or the possibility to take too much loan compared to your income, they are not very popular amongst politicians, they are not very popular amongst banks, and they are not very popular amongst borrowers. They are only popular amongst central bankers and supervisors, so we are in the minority. But besides households, specific sectors might end up in distress. Think, for example, energy-intensive sector and commercial real estate markets that can be significantly impacted by the higher interest rates. And we also see high and increasing risks in the market for highly indebted borrowers' leveraged loans. As I mentioned, the NPLs reached a new low. However, we have seen an increase in so-called stage 2 loans, that is, loans with a worsening risk profile. And at this juncture, and this is what I'm saying is important, adequate credit risk management is a key supervisory priority. Banks' provisioning practices and capital planning should account for the deteriorating risk environment. And what we ask banks to do is to update their financial projections and underlying macro assumptions. They need to take into account that the market environment is deteriorating and have their forecasts based on those figures. This uncertainty calls for extreme prudence and the need for both banks and supervisors to swiftly adapt to a rapidly changing environment. But how should we prepare for this? Last Monday, or is it do we say this Monday, because it was this week Monday, the ECB published its updated supervisory priorities for 23-25, outlining what we expect from the banks. With the updated supervisory priorities, the ECB intends to strike a balance between two overarching objectives. On the one hand, making the necessary effort to strengthen the resilience of the banking sector to immediate macrofinancial and geopolitical shocks. And there we emphasize credit risk management and diversification of funding sources. And then, on the other hand, ensuring that banks stay focused on addressing the structural vulnerabilities that were identified last year. I was in a banking conference just a few weeks ago, and there the CEO of a major, very big European bank confessed that he had never faced such a complex situation as today. In addition to the deteriorating macroeconomic outlook with its impact on the credit book and funding conditions, banks need to invest heavily to cater for looming operational risks with increased threats of serious cyber attacks and also active hybrid influencing. Digitalization poses new operational risks and exposes banks to competition from service providers outside the banking sector. And geopolitical and political risks play a role that the banks and supervisors cannot ignore. The Russian brutal aggression to Ukraine has had its side effects to the global economy and risk outlook. And naturally, the main theme of this conference, climate risk, is today high on everybody's agenda. Today, I would like to highlight two of the priorities in a bit more detail. The one being related to climate-related issues and the other on cyber. But before I do so, I need to also emphasize the importance of the good governance and management bodies functioning and steering capabilities. What we have seen that in management bodies, the members do not always actively take part in the discussions. They don't challenge the management, and they don't always have the expertise needed. And nowadays, for instance, the new expertise that is needed, there is expertise on IT issues, cyber issues, and climate. And that we find very important. But if I talk about the climate issues, so I would like to just tell you what we have been doing on that front. Climate-related and environmental risks for banks include the transition towards a more sustainable economy and the need to adapt to increasing physical threats. And the current energy crisis is a preview of what a disorderly transition could look like when recent extreme weather events are reminders of the physical risks ahead. This area has been our key supervisory priorities also last year, and we have carried out several initiatives that have provided information on banks' preparedness. I think we are the most active supervisor in the world on this field. In 2020, we published a guide on climate-related and environmental risks, outlining our supervisory expectations regarding banks' risk management and disclosure in this area. This was followed by a request to the banks to perform a self-assessment, and there most banks recognize in this self-assessment that they have significant exposures to climate-related and environmental risks, And at the same time, 90% of the banks considered to be only partially or not at all aligned with the supervisory expectations, and so a need to improve the management and disclosure of the risks. Then we have also carried out a stress test. It was a learning exercise for both banks and supervisors, and a thematic review analyzing how far banks are currently aligned with the supervisory expectations. There we noticed that 85% have at least basic practices in most areas. But the stress test. The results gave a solid overview of European banks' preparedness regarding climate risk stress test framework capabilities. Our learnings there are twofold. On one hand, banks have made good progress, but on the other hand, there are still major deficiencies in banks' climate stress test capabilities that need to be addressed. Overall, banks do not sufficiently reflect climate risk in their stress test frameworks. More than half of the participating banks lack a climate risk stress testing framework entirely. Furthermore, most banks exclude climate risk from their credit risk pricing or risk management models. Also, banks still rely significantly on carbon-emitting sectors. And for the calculation of financed emissions and energy performance certificates, banks rely heavily on proxies. They therefore need to step up their customer engagement in order to collect better climate-relevant counterparty data. And in terms of physical risk, the bottom-up stress test showed that vulnerabilities highly depend on the geographical location of exposures. Well, that is easy to understand. But regarding banks' long-term projections under different climate risk scenarios, results show that an orderly green transition translates into lower losses than a disorderly one, and one without any policy action. The test finds also that banks don't have detailed long-term plans. They have the tendency to reduce their exposures from the most polluting sectors and supporting less carbon-emitting businesses, when actually we would like them to have differentiated plans per each possible long-term scenario. We think that banks need to also improve the inclusion of climate risk into their long-term planning. But despite all this progress that has been also positive, banks still need more sophisticated methodologies and granular information on climate and environmental risks. The real problem is lack of reliable data. And banks continue to significantly underestimate the breadth and magnitude of such risks, in our opinion, and almost all banks have blind spots in identifying them. And there are also significant gaps in how comprehensively banks address climate-related and environmental risks. There is also supervisory concern related to the execution capabilities of most banks. What we have done, we have set institution-specific deadlines for achieving full alignment with our expectations by the end of 2024, and I personally hope that those expectations are met. But then addressing another area, it's the digitalization challenges, and there I think that the world during the past few years has changed a lot through the digital transformation, and also due to the political environment. If you remember anything that I'm going to say during this introduction, so please could you remember the following, that at least the following, in my opinion, is quite important, because in the current weakening economic environment with heightened geopolitical tension, It's a prerequisite for maintaining their resilience that banks meet their prudential and liquidity requirements with adequate buffers and have sound risk management practices. But what I want to emphasize is that this is not enough. Capital and liquidity, even good governance, is not enough. Banks need to cater for operational risks in their various forms, with particular attention to heightened cyber threats and IT-related vulnerabilities. That's a must, because even though we haven't had very serious attacks so far, banks need to be prepared. Digital transformation and the increased dependence on new technologies and third-party service providers have increased complexity and interconnectivity within the financial system. Cyber attacks have become a major challenge to banks' operational resilience in recent years, being especially difficult to handle both because of the growing complexity and fast-changing nature of the related threats and because of their cross-border dimension. The head of Norwegian Wealth Fund mentioned in one of the Financial Times interviews that, in his opinion, the biggest risk, his biggest concern was cyber threats. And the current geopolitical situation is posing new challenges in this regard. While the threat of massive cyber attacks following the war has not yet materialized, the number of cyber incidents reported by supervised institutions has been following a rising trend, even though it has still been pretty stable. And although the awareness has increased in banks, we still see deficiencies in cybersecurity, which concerns the preservation of confidentiality, integrity, and availability of information through interconnected information infrastructures. There are 5 things that we expect from banks. It's like understanding the cybersecurity risk to systems, data, assets, to implement safeguards, to ensure appropriate level of protection, timely detection of incidents, breach, safeguards, and then develop capabilities to contain cybersecurity incident impacts. And this is important again, preparedness to timely restore services and capabilities. A bank doesn't really, couldn't really service its clients if their clients do not have access to their money or cannot transfer money from their accounts. So of course, restoring the continuing the services is extremely important. We will keep engaging closely and in a targeted manner with banks with the objective of strengthening their IT security and cyber resilience frameworks. Also, we will look at banks' outsourcing risk arrangements, as IT and cyber risks may also arise from vulnerabilities present in third parties providing critical services to the banks. In fact, high reliance on third parties for critical IT services and deficiencies in IT outsourcing arrangements continue to present a material vulnerability, which could result in increasing losses owing to unavailability or poor quality of outsourced services. I can also imagine that, and I hope that in the near future we could also carry out a stress test, cyber-related stress test, to gain further experience and continue to build up awareness in this important context. It could also help to assess whether banks have the operational capacity to ensure the continuity of their critical services. Also, as you know, there are many regulatory initiatives in this area, like the DORA proposal, but I don't want to go into it now. What is also one concern is that Is there enough expertise amongst the banks, amongst supervisors regarding cyber resilience? And that is a really concern that affects us all. And of course, that's why also I think that it's important to have cooperation with other authorities. It's a key element to continue to protect and tackle any risks. And other authorities, I mean other national cyber security centers, even the Secret Service, if they are willing to cooperate. But anyway, this is a risk that should not be underestimated. Thank you.
Thank you very much. Thank you very, very much. Let us remain on the new frontiers in banking, and I pass the word to the floor to Paolo Angelini, Deputy Governor of the Bank of Italy, for, I think, more remarks on ESG aspects, which are so key to our near future, as also, to put it in Mike Spence's words, how we need to manage effectively the multi-decade transition that awaits us. So the floor is yours, Paolo.
Thank you, Marina. Thank you for inviting me to this roundtable, and thank you to Anneli for setting the stage, so to speak. She has been giving a broad brush picture of what the SSM is doing on the front of sustainability risks. I will go much more specific. I will delve into a specific subject, which on the one hand is very specific, on the other is broader in that it affects intermediaries, financial intermediaries by and large. It does not really concern only the banks. And the theme that I would like to focus my remarks upon today is the one of transition plans. Now, probably the issue is known to most of you, but just to set the stage, what I mean by transition plan is generally understood as a detailed description of actions that a company, be that a financial intermediary or a non-financial firm, agrees and pledges to implement over a number of years. It could be a long period in order to comply with the given environmental target, which can be again phrased in broad terms, E, S, and G, or just in terms of climate, for instance. One example is the net zero commitment that is envisioned in the Paris Agreement, net zero commitment by 2050. As you probably know, a large swath of the financial system at the world level has pledged to achieve these targets by 2050. Probably the best known initiative worldwide is the so-called GFANZ, the Glasgow Financial Alliance for Net Zero, that has been launched and sponsored by Carnegie. The GFANZ has components such as the Net Zero Banking Alliance. The similar effort is conducted by insurance companies, by asset managers. So it is really a broad initiative trying to steer the financial system toward this highly desirable objective. The ECB is to some extent following suit with two hats. One is the monetary policy hat. Some of you may have noticed that recently the ECB has announced a plan to decarbonize a specific portion of its monetary policy asset, the so-called CSPP, the Corporate Sector Purchase Program. It's basically bonds of non-financial corporations. And as Anneli has mentioned, the SSM is also very active in encouraging banks to tackle these risks. Still in a line from what I expect Giovanni Sabatini to say, I must say that there is a big difficulty on the part of banks on this front, which is exogenous to the banking system. And Anneli mentioned that there is a huge issue of data, a data problem that is clearly in the making at the moment, and that finds everybody to some extent in the same shoes. Governments who are trying to tackle the energy crisis, banks and supervisors, we're all tackling this issue. Luckily, things are moving. There is progress on various fronts, but we're still in a journey on this front. Back to the issue of transition plan, I would like to focus on two specific issues. The idea to pledge toward net zero and to decarbonize is clearly appealing, to some extent intuitive, but there are details that need to be heeded. One is the one that Anneli just mentioned. The ECB is talking to banks in order to get them to acknowledge transition and physical risks properly in their policies. And Anneli mentioned that one knee-jerk reaction by banks is just to decarbonize their portfolio by moving away from carbon-intensive sectors toward less carbon-intensive sectors. So just to make a clear and simple example, one could envision two extreme strategies in order to face transition risks on the part of intermediaries. Again, not just banks, but institutional investors just as well. One is this, let me call it simple way, that is from an individual viewpoint. I decide to announce a decarbonization target, 5% per year of whatever indicator you like of carbon intensity of my portfolio, and implement it by divesting or cutting credit to be in banking terms to carbon intensive sector, and moving my lending portfolio or my bond portfolio or my shares portfolio toward less carbon intensive sector. To be clear, sell Shell and buy Amazon. That can clearly lead any financial intermediary in isolation to decarbonize its own portfolio. The second option, extreme option, that the SSM is sort of nudging banks to implement, is to look at what the system is today and what the system should be 10 or 20 or 30 years from now. And that brings back the issue of transition plans that I was mentioning at the outset. Today, many companies, especially large polluters, have transition plans. In Italy, a clear example is Enel, for instance. It's the main provider, one of the main companies in the electricity sector. So if you look at their carbon intensity today, it is clearly very high. If you look at what they intend to do, you see that they have basically a transition plan involving a plan to invest and to search for new technologies, so that in principle, if they are lucky enough or good or clever enough, good enough, they should be able to do this. So the intermediary has, in principle, two options, right? They could go ahead and invest in highly carbon-intensive sectors today, or use the dumb type of strategy that I was mentioning at the beginning. Clearly, this second approach can even entail an increase in the carbon intensity of the current portfolio of intermediaries if they decide to go to finance highly carbon intensive that are engaged in an important transition path. But in principle, it is what one would expect the financial system to do. In reality, what we see there is that there is a strong relationship between the current and the expected carbon intensity. The firms that are at present very carbon intensive have very aggressive, on average, transition plans, and therefore they plan to reduce their emissions in the future. So there is some sort of a difficult choice to be made by financial intermediaries, by and large, on which approach to follow. Individually taken, each financial intermediary can get away with the simple approach to divest from carbon-intensive and moving into less carbon-intensive firms or sector. But of course, this is an approach that suffers from a fallacy of composition. If everybody does that, what happens to the need for finance that are really critical among the big utilities and the carbon-intensive sector, which need to survive unless we have a breakthrough, technological breakthrough that we're reading about in the papers these days, but seem to be not really close at hand, or unless we have a radical change in consumption patterns, especially by Western households who are accustomed to using a lot of energy. So there is an increasing awareness in the market on this front. People know what this all means, and there are efforts by GFANZ, by various other think tanks. Let me mention the Portfolio Alignment Team, which is also sponsored by Mike Carney. That what is required is not to divest brutally from carbon intensive into and going into the less carbon intensive sector, but there is a need to finance the transition plan. But all this entails complexities, complications. Let me just mention one. At the world level, there is a few thousand firms who have transition plans available. All the rest, the millions of other firms, don't even know what we are talking about today when we talk about transition plans. Least of all, they don't have the data about their current emissions. So there is, again, this issue, a huge issue of data availability. And I think we all have to be aware of these complexities. The supervisor, when we as supervisor push banks to adopt, carbon careful strategies, politicians, statistical offices, and most of all, I would argue, non-financial firms who need to put their act together and work intensively on the issue of the data availability. The second potential problem with these transition plans that are so popular today has to do with the fact that the relationship between the transition plan itself and possible other objectives of an investor have not been clearly brought to light for the time being. Let me be more specific on this front. When I talk about transition plans, as I said, I have in mind all these large financial firms to begin with committed to reaching net zero by 2050. Now, this is a stark commitment to affect their own portfolio in order to reach that target. So far, researchers, I'm sure some can be in this room as well, have been looking at the returns side of these initiatives. There is a lot of finance being mobilized to fund ESG investment, environmental investment in particular, and researchers have been looking at the returns of these strategies. And more or less what we see for the moment is that returns from ESG investing is at par compared to more traditional initiatives, or possibly a little bit better. If you look at the last 3, 4, 5 years, you see that ESG investing has earned a small return. In the literature, this thing is called as greenium. There is a premium for those companies who issue sustainability-linked bonds, for instance, or green bonds. Not only companies, there are, as you know, governments who are in this line of business. The issue, however, is whether this premium or movement at par with the traditional investing strategies is to be taken for granted, or whether it may at some point disappear. Some argue that this premium, this greenium, this relative better performance of ESG investment has been driven by a surge in demand that has characterized the last 3 to 5 years as investors, households, institutional investors, banks, etc., have grown more and more aware of the problem and wish to do something for the good of the planet, so to speak. But it's not obvious that going forward this pattern may go on. So my bottom line is that it cannot be excluded that at some stage the traditional investment objectives, which is basically a return for given risk, may come to clash with the ESG objectives. And this could be a problem, for instance, for all those intermediaries who have pledged a net zero pledge for 2050. And if this clash were to pass, the question I asked is which of the two objectives should be sacrificed? Which objective is BlackRock or any big investor who's pledged to net zero is going to sacrifice? And I've been looking for answer to this. It is genuine answer, a genuine question on my part, and I haven't found much yet in the literature or on the internet, in spite of the burgeoning amount of work that is being done on this. Quite recently, I found a recent report published by the GFANZ, the Glasgow Financial Alliance for Net Zero, that puts forward an answer. And the answer basically is that this trade-off, potential trade-off, clash between environmental objectives and return objectives should be addressed in a financial firm's transition plan. Let me quote, they say that the plan should include a statement detailing inter alia how the institution plans to address potential conflicts between its net zero ambitions and profit-making opportunities. Now, said in different words, this amounts to saying that the preference for sustainability should be an argument of the intermediary's utility function at par with the return. So it should have a weight of its own. So the intermediary should explicitly state if and to what extent it is willing to sacrifice returns for sustainability. Should this turn out to be the case? Maybe not. Maybe we are all lucky and we go on without having to do this sacrifice, but the possibility is there. Now, if you follow this line of reasoning, you see that there are potentially huge implications for financial intermediaries' behavior and for their transition plans. First reaction that I had is that it seems doubtful that the net zero commitment can be credibly announced without mention of the returns issue. Net zero pledges should, in my view, more appropriately be viewed as conditional commitments. That is, I'll commit to net zero until somebody tells me you're losing too much money, and then you have to quit. And I think that is something that has yet to emerge. To my knowledge, to this date, no intermediary has been explicit about this potential trade-off, about this risk. And the possible reason is that most of them, I'm not talking about the banks, but I'm thinking about asset managers, for instance, most of them have a fiduciary duty towards their clients, their households and savers, whom are the other part of the story, and they are not in a position to get a mandate from their clients telling them, okay, I'm willing to give up yield for the good of the planet. And this, I suspect, is one of the reasons why that underlines some recent developments that you may have read in the press. To quote the last one, Vanguard, that is, the second largest asset managers in the world after BlackRock, recently announced the intention to pull out of the Net Zero Asset Managers Initiative, out of GFANZ, basically, quoting the need to demonstrate independence and clarify its views for investors. And that is clearly something that may, start to expose the cracks of this initiative that relies solely on the financial system. Marina, I think I will stop here. There are other things that could be added to this, but I think I see there's some doubts.
Thank you very much. So clearly, transition plans, and there's a heavy burden on the right, a necessary probably heavy burden on the side of banks. But let us hear from Giovanni Sabatini the point of view of the people who are actually in charge of banks and actually have to deal with some of the difficulties that there are with regard, for example, to data. One of the points that I made a long time ago at an EBA and JRC seminar, I think it must have been 2018, was regarding, for example, the differences that there are between countries. Because where you have larger companies, for larger companies it's easier to provide ESG data, whereas it's much more difficult in countries where there are many smaller companies, which of course are not accustomed to providing this sort of data and actually don't even have the slack to do so. So of course there is the side of the European regulation regarding supply chains, which is going to be on the listed companies' requirements. But for sure, banks do need to play a role in financing. Again, I really enjoyed Mike Spence's definition, our multi-decade transition, because it's going to be a long journey and possibly a difficult one. So Giovanni, the floor is yours.
Thank you. Thank you, Marina. And it's a great pleasure to be here with this very distinguished panel of speakers and audience. And the sheer quality of the discussion today speaks volume. It reminds us of the urgency and complexity of the task ahead, not just for the financial sector, but for the European economy and society as a whole. And I couldn't agree more on the statement that we are facing a very, very difficult time and a very difficult conjuncture. So what will the economy need in the short and medium term? How can banks finance these needs better? These are the questions on which I will try to elaborate a little bit today. And indeed, in addition to my engagement as with the Italian Banking Association, I have also the privilege of a European perspective, since within the European Banking Federation, I'm chairing a strategy group that concerns itself with the financing of the economy in a sustainable and inclusive way. So I would like to share with you my thoughts on challenges facing European companies and citizens and how banks can help and which policies can add to our financing power so we can better meet these needs of today and tomorrow. So first, about the needs of today. As President Ursula von der Leyen recently put it, making ends meet is becoming a source of anxiety for millions of businesses and households. And she is right. And let me be clear about this. Today, it seems to me undisputed that the top priority is to continue the recovery from the pandemic and to overcome the current economic scenario. But unfortunately, there is little doubt that Europe is headed towards an economic recession. We are currently facing multiple crises. Unlike the pandemic crisis, which was mostly about liquidity, today's risks are about solvency, and they are complex. I know that we have distinguished economists in the panel, so I will not only outline some of the causes. There are disruptions to the global supply chains, which were caused by the pandemic and not yet resolved. They create production bottlenecks, increased costs, and reduced supply, all of which affect especially our goods-producing industries. At the same time, new disruptions have materialized to the Russian invasion of Ukraine. We are seeing the most tangible impacts on oil and gas prices, but also more generally on trade. And this leads to higher and volatile energy costs, inflation, reduced economic prospects for some regions, and food shortages. The euro area GDP growth in 2023, for example, is expected to fall to less than half of the 2021 level, and no European country is spared. For many businesses, the prospect of suspending production is becoming more and more concrete. This begs an urgent question. In what condition are European companies facing these challenges? European companies are coming out of the COVID-19 crisis with very significant levels of debt. Their investment capacity is overstretched. The exceptional increase in the cost of energy pushes companies to get new banks' debt, pressing down their financial situation and making it more difficult for them to hedge their exposure on futures markets due to high margin calls. So, it is therefore crucial that we help companies and households minimize the impact of the crisis. It is essential to make the burden of bank debt for companies more manageable and to favor the redefinition of a repayment period along longer maturities. Banks want to be a part of the solution, as they did during the pandemic. Banks are a critical force to fight against economic recession. They are better capitalized, better positioned, and can count on a considerably better asset quality than during the 2008 financial crisis. However, just as they were instrumental in mitigating the impact of pandemic, banks need to be put in a position to provide support to corporates in the proper way. This means two things: helping companies free up capital for immediate relief, but in a way that is consistent with the long-term objective of decarbonizing and digitizing our economy, and avoiding pitfalls that would constrain capital, weaken policy responses on trade today's problems with tomorrow's. Failing to act on time may make the difference between preventing or allowing an impressive increase in the default rates of firms, which would also result in a new wave of NPLs for banks. So, to put it differently, financial stability is key, but is a precondition, as the final goals is to support growth, employment, and competitiveness. So we have to find the right balance. And as Executive Vice President Dombrovskis remarked recently, to help weather the storm and support growth, banks need to be agile. And let me say that the same could be argued about regulators and supervisors. In my opinion, the best solutions stem from the successful combined policy reaction of regulators, supervisors, and the private sector, as the experience of the pandemic crisis has shown. Let me stress that during the pandemic, we had the very fortunate circumstances where monetary policy, European fiscal policy, and the European regulatory policy worked together in the same direction. This is not the case today. So, again, let me give you some example. At the height of the pandemic, high volatility in relation to government bond prices constrains bank ability to allocate capital to companies in distress. However, thanks to the combined efforts of the public and private sector, a regulatory quick fix was rapidly introduced to neutralize unrealized gains and losses in the balance sheets of banks. This provided stability and freed up capital that proved instrumental in mitigating the impact of the pandemic. And this is one, together with other emerging measures, injecting some flexibility in the banking regulatory framework that proved essential to face the pandemic. And let me mention, as it has been reminded, the role also of the moratoria and the flexibility granted by EBA to avoid the automatic reclassification of exposure subject to the temporary suspension of the repayment of the installment. That was extremely helpful to reduce the number of defaults for firms and households. So I think that we should learn from this experience and understand that flexibility made us more resilient. We believe a key measure would be a review of the EBA rules on the definition of default that currently discourage forbearance measures by banks. In order to ensure that the debt level of European corporates remains sustainable, banks need appropriate regulatory flexibility on moratoria and renegotiation of existing loans. However, according to the current rules, a bank granting a forbearance measure must classify the beneficiary company as defaulted if this operation involves a reduction in the net present value of payments greater than 1% of the provisions of the original loan agreement. And today, the level of 1%, also taking into account the level of interest rate, is too restrictive. And the European Banking Federation has jointly been advocating for an increase, or at least to making this threshold more flexible. This would allow banks enough room of maneuver to help viable clients. So, at the beginning, I mentioned that we cannot forget the financing need of tomorrow. So, again, if I could spend hours discussing the current regulatory framework, let me move on the discussion on ESG matter. So, in my view, it is evident that there can be no real solution to the current challenges without sustainable growth. Maintaining the focus on the green and digital transition is key to reinforcing resilience in the future. I will say a few words on both fronts, starting with sustainability, which is a hot topic of this meeting. The transition to a sustainable economy will require a substantial amount of investments, even more so in the current context. It is urgent as, let me say, climate change does not wait for us. As banks, we need to maintain the commitment to net zero emissions and channel financing towards more sustainable activities. And banks are willing to do their part and are already taking concrete action to facilitate the transition. Most European banks have been made net zero commitments, joined climate action initiatives, and started to produce climate-related disclosure. Many have begun to embed climate risk into their processes and to align lending portfolios with their climate commitments. But the economic and political volatility triggered by recent shocks are having a significant effects on bank strategies. In particular, the war in Ukraine has slowed down the transition agendas. Banks have not changed their overall risk appetite, but sector attitudes have been affected by rapid changes of the economy position of different industries. The greatest effect is on the energy sector, which is overweighted by 50% of our respondents. There is also an increased focus on transportation. In contrast, mining and metal business services, manufacturing and industrial are comparatively underweighted. Despite the short-term hit to transition agendas, European banks remain fully committed to their net zero goals, and this reflects climate science, demand for clean energy, and banks' duty to support the transition reinforced by supervisory, public, and political expectation. Banks, however, face major hurdles as they seek to support the real economy while continuing the process of decarbonization, and this includes inconsistent disclosure, uncertain government policies, and the need for sector-by-sector transition pathway. But I will come on this later. On the upside, many banks see the current crisis an accelerated medium to long-term demand for clean energy finance and infrastructure renewal. Banks' ability to successfully manage their balance sheets while meeting stakeholders' expectations will not only depend on macroeconomics, but also on the action of clients, governments, and regulators. Banks can influence these outcomes through thoughtful collective engagement. However, banks cannot make it happen alone. And this is a point that I would like to clarify and highlight. Banks have the tools to support their clients, but they cannot have authority of their activity. To put it simple, banks cannot police the transition. If authorities believe that a certain economic activity must not be practiced or must be reduced, the right path in our way is that they make use of their tools to impose so by directly regulating that activity. It is not appropriate, not feasible, to regulate manufacturers through the financial sector and by prudential regulation. Among other things, we deem not appropriate and even counterproductive to put on the shoulder of banks the responsibility to decide which activities are not desirable for the society. Prudential regulation should remain focused on financial stability and risk-based. The pursuit of other goals might jeopardize its effectiveness. But beyond this more general problem, we have also practical concerns about implementation of possible banking regulation aiming at ESG goals by means of prudential constraints. We all need to do our share to implement the sustainable finance framework to achieve its objectives. And our approach is not to complain or obstruct, but rather to point to practical solutions. And I want to mention two critical implementation problems: the data that is needed and the sequencing of the pieces of the framework. Just to mention, only at the end of November, EFRAG submitted to the Commission the first set of European sustainability reporting standards, while the requirement for disclosure of their exposure to decarbonized or carbonized high-intensive carbon sector for banks started well before. And there is a long transition phase, a long implementation phase. So the 2 points are intertwined. The availability of reliable and comparable data should be considered a precondition for banks to take informed decisions in extending credit to firms and managing the inherent risks. But this is not the scheme that the regulation has followed so far. Anyway, banks are doing their best to progress as quickly as required and to solve this problem. We engage in a close dialogue with supervisors and regulators, and I would like to take this occasion also to thank both the Bank of Italy and the SSM for the constructive dialogue that we have started both as ABI and EBF on this issue. It has been mentioned, the issue of proxies. This is a real problem that has to be addressed and solved, lacking reliable data from our counterparts, corporates, and particularly small and medium enterprises. So I have some also a few thoughts on the digital transformation, but because of time constraints, I can stop here. Thank Thank you.
Thank you very much, Giovanni Sabatini, Acting Chairman of the Executive Committee of the European Banking Federation and ABI General Manager. I forgot to say before. Now, we've heard a lot about banking, but of course, capital markets are also part of the story. Actually, they're a big part of the story. So we have here also the point of view of Consob Commissioner Carlo Comporti, who is going to tell us the new frontiers in capital markets. Thank you very much.
Thank you. Thanks to you, Professor Brogi, for having invited me, and for also two very important reasons. The first is to having gathered a panel of, let's say, distinguished speakers, but I would say also friends. So, and it's a big pleasure to sit together. The second is that I've not been walking through the gate of the university for a long time, and with some emotion I've been doing it again. So thanks again for making this happening. More seriously, on the topic of this panel from the capital market perspective, I just would like to offer a few personal thoughts. Of course, it's a selection of what is happening. I would not bring necessarily to another planet. You said that, of course, the two perspectives may interact, and of course there are some common perspectives, common areas, but probably different perspectives, and that is where I would like to bring you with this overview. And these are not necessarily in good orders, so forgive me for being a little bit probably jumping here and there. But I would try to start with what I would consider the most challenging topics from the perspective of a national securities regulator, looking also at reflections on the European integration, and then evolving into a more forward-looking perspective of what may appear in the radar screen, but starting from what is visible currently. The very first point is that we have been working, by the way, the person that have been sitting at this table have been very much instrumental in the past and recently on to have a successful single market. Okay, that had been and is still one of the key policy objectives of the Union. And I think that personally and from our respective institutions, we have been playing well. Overall, I want to share let's say, something that is not necessarily working very well, and that is the passport. Now, we have been doing a lot to make the passport functioning. What we are experiencing, and I'm referring to very concrete cases that have been brought, by the way, to recent events, relate to the fact that the home host jurisdiction relationship is probably suffering from an imbalance of powers. I'm referring specifically to situations whereby, for specific reasons, firms establish themselves in jurisdictions that may be relying on less, let's say, stringent supervision, and this is bringing to damages and real damages on other jurisdictions. Since traditionally we are in a country that, for good reasons, is a host jurisdiction, what we are suffering is from, let's say, investors that are not happy because they lost money, including, I would say, somehow a lot of money in certain situations, whereby knocking the door of the most, let's say, the closest regulator would not in itself solve anything, because the closest regulator in that case, I speak for, let's say, the organization I'm belonging at, is completely, let's say, deprived of any power. And I would say from the perspective of also knowing what is going on. So from this perspective, one of the first point, looking back also at what we have been building up, is that we have to somehow reconsider the balance between the home and host relationships from the perspective of powers, from the perspective of disclosure, from the perspective of, let's say, making sure that this is really played on a clear level playing field. Now, how to do this? Clearly, there are two ways, and I would strongly advocate for further work on this direction. Just because we are truly believer that the single market is a good, let's say, good for Europe, including at national level. And the two directions are, of course, one, ensuring supervisory convergence. To some extent, I think that what our, let's say, collective activity has been producing a good outcome from the perspective of a single rule book. Basically, I'm exaggerating by piling up a number of very detailed and I would say very precise set of new rules. But we haven't done the same from the perspective of achieving how these rules are implemented evenly across Europe. And supervisory convergence should be really on the priority list of our daily actions. Otherwise, I think that the passport will not work. So we created the condition for the function of the passport. Now we have to move rapidly to making sure that this is happening evenly, because otherwise the passport may create damages. The second one is that there are still areas where the rules are not fully harmonized. And that is still creating some areas of tensions. Now, I look at what the Commission just published a few days ago about another wave of a pillar under the Capital Markets Union. Very welcome. I think that there is still further areas where the harmonization of rules is needed in order to complete the function of the single market. So my very first point was on where we stand on the single market, and some lights, but of course some shades that we need to address very rapidly. The second one, and I'm really coming to the present, okay? I think that our previous speakers already mentioned the current crisis. From the perspective of capital markets, I cannot, let's say, deny the fact that we are worried about the preserving the capacity of markets to work in an orderly and efficient manner. And I'm referring specifically to the energy markets, whereby there are two reasons of concern: some legitimacy in terms of reference prices that would be used across Europe for the sake of either, say, making transactions or hedging about transactions of risk. And these may not be done on a pure, meaningful basis. And the second one is introducing some mechanism in the orderly function of the markets. We are discussing at the level of Council and Parliament potential price caps. Of course, from the perspective of securities regulators, we try to influence the good and to preserve the good function of the markets from the perspective of reducing and managing the volatility. These are not necessarily the same tools, and potentially some may interact with the others. And the last point is that there have been a number of discussions around the increase of margin calls. Prices, volatilities are making these margin calls very volatile as well. Of course, accordingly, But the amount of these margin calls has also called on the capacity of certain industry sectors to cope with these new, let's say, calls and requests. And here, the position, I think, again, may lead to some sort of discussion about the trade-off. Is the risk, let's say, that is emerging in some sectors to be shifted over to the financial sector? Probably these would not be necessarily wise. We created some time ago, very recently, the potential for CCPs. I remember the G20 communique from Pittsburgh after the crisis, to have CCPs as strong and resilient, let's say, infrastructures, shifting the risks from one sector because it's emerging to another one would not be necessarily the wise solution. I think Giovanni Sabatini was referring to shifting risk from in the transition. I'm referring also to what we are experiencing in the energy market. The third area where we see, let's say, current challenges is, and here I would basically leverage what has been said, but probably bring in from a different perspective, are the two major transitions that we are all experiencing. And these are really rooted in the global economies at any level. The sustainable or green transition and the digital finance. Now, I would limit myself to just a few words because much has been said. On the green one, clearly, the big challenge that we see also from our perspective that we are used to liaise with a limited number of companies that are the ones that are listed or making access to the public markets. Clearly, the interaction with a much broader, let's say, pool of companies that will have to disclose their transition plans, by the way, or other transition-related matters is huge. That raises the question of data, the quality of data, and I would limit myself to make 2 points. The first is, has been recalled by Giovanni Sabatini, the disclosure standards that have been just promoted. By the way, it's a first wave. And what we see is that these standards, Giovanni referred to the European ones just released by EFRAG, but there are global standards that, let's say, are also in the making. If the two, but I'm taking just the European, the global perspective, but these may work also for other regions. If the two are not interoperable, that would create a real mess in terms of ensuring a good understanding of what's going on from the perspective of investors and the public as such. The second one is greenwashing. I think nobody, and rightly so, has until now in the panel raised this point. It's a clear risk, particularly from the perspective of investor protection, because the risk that somebody may use this opportunity to pass as green, something that is not in reality, is something that should be clearly tackled and monitored. Easy to say, difficult to do in concrete terms. What we are doing, making reference to labels that may rely also to some quantitative aspects about the investments and really making these somehow rooted on something. Second, look at the ratings, and the European Commission may shortly issue regulation on ratings. I'm talking about ESG ratings, not the credit rating, ESG ratings, and of course data providers, because this has been mentioned, data is instrumental, but also data providers are instrumental for this. But then, of course, that is just one part. Then we have to look at supervision. Supervision, we just started thinking on how to make these evolving, but this is a new area and is not necessarily easy. On the digital finance, very briefly, I would bring the perspective of investor protection. We see scams, frauds. I would not even mention, let's say, some recent scandals. The key question is why investors, particularly retail investors, have been heavily invested in these potential gold opportunities. Clearly, I draw one conclusion. We have been issuing warnings. These have been completely, I would say, largely ineffective. So we have to also to reflect on our side how best to make our warnings, because we looked at these and we used warnings, but these have not been really successful. Second, we are worried about the potential hybridation between the regulated and the unregulated. Look at the FTX, TFX, and you will see that clearly there were certain regulated entities and largely most are regulated. But what we see is that even in normal transactions, you have regulated entities also having a part of the chain of a transaction in a less regulated. And that creates also some confusion and blurring of competencies. And third, more broadly, a potential loss of confidence by investors. There may be some segmentation of investors that we have to look at more in depth to understand how this phenomenon is happening. But more broadly, when there are larger scandals like the ones that are facing, clearly the investors may be affected at cascading level more broadly and with a potential loss of confidence. I would then turn to, I still have 2 minutes. 2 minutes, yes. To the more forward-looking, let's say, issues. And let me start by something that is really worrying me, and that is particularly, it's a global trend, but in Italy is particularly, let's say, clear, is the shift of certain funding. And I was just referring to two large transformations that needs important funding to private markets. Now, these private markets, let's say, I have nothing against private market. Of course, they should be complementing, let's say, other, let's say, channels of funding. But when we come to see that these are really substituting, as we see in many Italian delistings from exchange, we start asking ourselves, at least myself personally, whether these will make, in the end, the public markets losing the inherent intrinsic value of public good. The reference prices that these public markets really give to the benefit of others may ultimately be affected. And we should keep in mind these in order to preserve the discovery part of pricing and valuation also for others. Clearly, there are good thinking. I was just thinking a listing act from the European Commission, but more broadly, that is something that we need to reflect. And the non-banking financial intermediation, more broadly, may raise a question in itself. And the second one is what just happened a few hours ago about the London Stock Exchange, let's say, the London Stock Exchange agreement with a large IT company. But it's beyond, in my view, the choice of a single player, legitimate choice of routing its business model on data. Okay, but let's say the potential transition of exchanges into the data-driven economy. It's something that we should also, let's say, raise questions on where the overall economy in terms of capital market is going and is evolving, and what would be really the value creation chain that we have to look at as regulators. Thanks.
Thank you very, very much. I think we have time for a really fast second round to comment on, what you've heard, but really just, some of you are too young, but I would say a telegram almost. Something very, very.
Are there people who don't know what is a telegram?
No, I think.
Wow. Or what is a telephone? The normal one. I was actually supposed to talk about the risk beyond the banking sector and some cryptocurrencies, but regarding crypto assets, I refer to the speech that was held maybe 1 week ago by your countryman, Executive Board Member Fabio Panetta. And I must say that I agree with him, because I also do see these assets or currencies as sort of, they are just for speculation and gambling, and they don't really bring any sort of benefit to the society, in my opinion. That's not the ECB opinion, that's my opinion. And also when the supervisors give, especially these, say, want to address consumers, which we don't that much at ECB, but anyway, it's not the consumers that we want to address that read our messages, it's the wrong ones. So that is a difficult way. But just a couple of things regarding, I'm of the same opinion that banks really cannot police the transition. So I agree with you, Giovanni, and also that the prudential regulation should be risk-based. On the other hand, regarding moratoria, I have the problem that with the moratoria, you lose the visibility, and that is the problematic side, that then banks do not anymore know their clients, and that is problematic. When it comes to greenwashing, also one needs to remember that it's a huge litigation risk. It's for, say, banks who have given some information about their goals that is not exactly the right one, and also all funds. I mean, it's of course the consumer protection side, but also these companies are sort of posed for these risks. And I understand that litigation has increased recently. And regarding the passporting, I must say that I can agree with you, and the current system doesn't really work, because if there are supervisors, home supervisors, that don't do their work the way they should do, or don't have the capacity or whatever, then there's a problem, and the problem should be corrected. I mean, it cannot continue like that. If we want to have a sort of integrated European capital market, we need to change this. Thank you.
Thank you, Marina. Many inputs. I'll just pick a few. Let me start with the moratoria. I agree with both Giovanni and Anneli, meaning that moratoria can be useful. In the Italian experience, the last round of moratoria, both the government-sponsored one as well as the private one, turned out to be a huge success. We have evidence that about 95% of moratoria loans went back to performing after the end of the period. And I remember discussing with colleague supervisors the risk that all of them might be in the end a proxy for a defaulted loan. So things have to be looked at with pragmatism, and I think moratoria can be an option. Again, there is a risk of losing the underlying, but losing sight of what's happening. I mean, but again, one has to look at what results can be achieved with the right tool at the right moment. At the same time, I understand, just to annoy Giovanni Sabatini a bit, I hear a request from the Bankers Association about more flexibility. There is this debate about this 1% threshold that moves a loan from performing to performing, and it seems as though this threshold makes a difference between heaven and hell. Now, this, I think, is a position that would have made more sense 7 years ago, when Italy, for instance, was at the peak of an NPL, a huge problem. Nowadays, we are back to the European average in terms of NPLs. Net NPLs are, I wouldn't say negligible, but in the order of 1.5% of total loans. We are in a position, the banking system is in a position to tackle them. And moving for a bank, a loan from performing to non-performing, UTP, for those of you who know these ugly acronyms, non-performing, unlikely to pay, doesn't mean that the bank has to abandon this client to his or her own fate. It can help the client no matter what. What we see is that the share of stage 2 loans is not really showing big signs of worry. Should we be relaxed because everything is going to go well in 2023? Of course not at all. But again, we don't see much in terms of provisioning on the part of banks. IFRS 9 is not being overly used. So, I think my colleague Anneli and the supervisory board are more than ready to be flexible, but there are trade-offs here on this matter as well. On the EU passport, I would like to echo the concern expressed by Carlo Comporti. It is really something that needs to be looked at. It is not easy to find solution because in principle, that's what you want for a single market, but in practice, you do have something that I wouldn't call regulatory arbitrage, but sometimes it begins to look like something. Final remark on the issue of data for ESG issues. Another thing that hasn't been mentioned is the auditing framework. The European regulation envisions a gradual kick-in of a more formal auditing framework for ESG data, but we're talking about years from now. So this is another very, very large issue. Somebody mentioned in the panel the issue of data providers. We're all relying on data providers who use data that are largely estimated and largely unaudited. That is another big issue that needs to be taken into account. Thank you.
I'll try to touch upon 3 points in a few minutes. The first one on regulatory flexibility. First, I think that 1% rules coupled with the calendar provisioning makes extremely expensive the offer of forbearance measure for banks, and so it's really discouraging. But I think here, and I would like to be provocative, I think for the time being, I fully understand the position of regulators and supervisors because in their mandate, the mandate is to ensure financial stability, and there is no reference to growth. So I wonder whether we should amend the mandate to regulators and supervisors and assigning them the role of ensuring financial stability, but also taking into account growth, employment, and competitiveness of the economy. On the point of ESG, I would like to try to answer to the very, very difficult question asked by Paolo on the trade-off between return goals and ESG goals. I wonder whether there is a difference whether we measure in the short term the two goals and in the longer term, because ideally, if you measure the return in the longer term and then you consider the time horizon in which environmental risk will materialize, then I would say that the two goals, return and ESG goals, converge. This could not be the case in the short term if you measure return on equity in the next couple of years when, and this is not the time horizon for ESG risk, then you may have this problem. But I just try to provide you a very first reaction on your question. Finally, on the point made by Carlo on the risk that financial activities moves from the regulated environment into a poorly or non-regulated environment, I think this is a very old issue. And again, also the development of technology highlight the importance of a shift of the regulatory approach from an entity-based regulation to an activity-based regulation. So responding to the principle, same activity, same risks, same rules, and same supervision. I know that this is easy to say and very difficult to achieve. Very, very long time ago, when I and Carlo worked together at Consob, and when we were addressing the issue of what we call the alternative trading system, so the emergence of platform for trading electronically shares, when major exchange were still open outcry. I wonder whether someone here recalls that stocks were traded in open outcry in public markets. And then at the time we were discussing whether these new entities were intermediary or markets, whether they should be regulated as intermediary or market. So it's a long story, but again, I think today is more and more urgent that we rethink the regulatory approach. Thank you.
But I will start by reassuring Giovanni that we are still discussing whether certain entities are platforms or venues, as we say now, or intermediaries. So that is a never-ending story, irrespective of the changes in the, or probably because of the changes into the regulatory framework. Now, my very few words on still on digital, because I think it clearly from all of us, let's say, emerge some, I would say, worrying notes about certain evolutions on a personal basis. Okay, but there are some good developments that we need to underline. And the emerging of new techniques clearly drive for efficiency in different perspectives and directions. And that is the good part that, of course, should be preserved. At which point of time, that is the traditional question, these should be brought under regulation. I think that the previous speakers referred to operational resilience, or indeed, from the perspective of already supervised entity, but the entities running and performing these techniques, and I'm referring to techniques because, for instance, distributed ledger technology is a clear technique, may trigger themselves like the large infrastructure providers of clouds, such as the ones that will come under oversight regime under DORA. So I tend to agree with Giovanni that the traditional paradigm is same activity, same risk, same regulation, clearly, no doubts. But we see certain emerging technique that may trigger another, let's say, layer of regulation and supervision on the entities providing these. And of course, the data, Paolo already mentioned again, data service provider. Now, I cannot resist by closing with something that, a point that Giovanni made earlier, to be agile. And of course, including regulators and supervisors should be agile. Regulators probably at European level have not been. We are all collectively, let's say, guilty for these successive stratification of rules. That is by no means what we would consider agile. Probably it may turn into agile for the use of certain techniques that may make the user more agile. But in terms of supervisors, we are facing the challenges of using SupTech. We are trying, of course, with certain experiments. We gave recent notice of certain good results, but the use of artificial intelligence, among others, is really a fascinating new frontier that would make for sure us agile in the future. Thanks.
So thank you very, very much to our panelists. I'm sure that everybody present and all my colleagues, we want to thank you from our twofold perspective as professors. It's been an excellent lesson, so as teachers you've been great. And as researchers, you gave us incredible food for thought for future practice-driven, relevant research. So thank you very, very much to everybody, and especially to our panelists.